I apologize for starting this meeting a bit later than expected. I want to welcome everyone to this maiden webinar for 2021. And we expect that this morning we're going to meet great panelists, speakers that are going to talk to us about financial literacy. And this webinar, excuse me, was put together by the Lagos State Chamber of Commerce and Industry in collaboration with Capital Field Investments Limited. And we hope that today's webinar is going to expose us to investment product opportunity for client wealth creation. And gone are the days where we have to keep our monies in the bank and we're expecting interest to come in. But this morning, I promise us that they're going to expose us to financial literacy, wealth creation, and understanding financial instruments like equities, fixed income, and many more. I want us to open our minds this morning. Capital Field is well positioned, I know that, to meet your investment needs. And I promise you that this morning, you're going to have value for your time. Without much ado, I'm going to introduce you to the wealth of speakers that we have here. We have with us the MD of Capital Field Asset Management Company, Mr. Mark Okwo, who is our lead presenter. Mr. Mark, you're welcome.
Thank you.
And we have two other discussants. Mrs. Titi Adeni, she's our Group Sector Executive Financial Services, Capital Field Investment Group. You're welcome, ma'am.
Morning, nice to be here.
We also have Mr. Segun Oye. He is the MD, Allocation Consulting Limited. You're welcome, sir. Hello, Mr. Segun. Can you hear us? Hello, Mr. Oye, can you hear us? Okay, I presume he's hearing us. Maybe his network is a bit interrupting him from responding. But without wasting much time, we'll kick off this meeting. And so we're going to call on Mr. Mike Okwo to take his place. Please, sir, you have the floor now.
Yes, thank you, Mona. And I also want to welcome everyone to this interesting presentation about investment product opportunities to create wealth. I think, let me just share my screen. Okay, so thank you for having me on this interesting topic today.
Yes, it's not here.
Okay. Okay, so we're going to be talking about investment product opportunities for client wealth creation. So the whole idea of this presentation is to give everyone a very good understanding of investment products, the features, the risk, and the opportunities to help you grow your wealth. Financial instruments. So we have 5 main financial instruments. We have the fixed income, currency, interest rates, commodities, equity, and credit. Within the fixed income space, we have bonds, we have money market instruments. In currency, we have FX spot. This is your FX currency balances. When do exchange from Naira to dollar or dollar to Naira. We have equity investments, and we have loans. In the forward market, we have the hedging instruments for our cash products. So this is when we consider investing in a bond that gives us a designed return, which is exposed to interest rate risk, where we will hedge this interest rate risk by investing in forward contracts, locking in the price in the future. We can also do this in the option market, in the international market, where we buy a premium to hedge against the financial instrument. This investment and hedging is strictly across fixed income, currencies, equities, and in loans. For example, you might have a loan from a company, but you might think, oh my God, will they repay me back after 5 years if you invest in a loan? And you can do this hedging by credit derivatives in the international market. So in this slide, we're looking at the financial instruments structured by client solutions. Who are the main clients? We have governments like MTN, or we have a government like Nigerian government that will issue a bond in the fixed income market to fund the budget. We might look for a company like MTN that will issue stocks to grow and develop its organization. We might also have companies like Dangote. They're building a refinery. They need to look for dollars. They go to the forex market to buy currencies. We could also have a company looking for a loan from a bank. They want to build a plant. So these are the financing needs of organizations, and investors on the right-hand side and traders are the ones that will make this happen. Traders create the market. Investors invest in this market. Investors are concerned about return and about wealth creation. I won't talk so much about hedging. This is not very common in our Nigerian market, but hedging in the international market is required to hold your investments position, hedging against the market or credit risk of that specific instrument. So what are investment assets? What type of investment asset class do we have, and what are they? As I described earlier, we have the equities, we have fixed income, we have alternatives. You know, fixed income is like an IOU, so it's an organization or a government borrowing from investors. They borrow a designed amount, and investors expect a return on this investment. In equities, you know, we invest in a company, and in some cases, we're looking for dividends. Alternative assets, we're talking about real estate, commodities, venture capital, and derivatives. We have different types of investors. We have the endowment funds, we have the banks, we have the insurance companies, the pension funds, the investment companies. The investment companies are the asset managers who will invest for its clients and investors. The sovereign wealth fund invests for governments, you know, with a different investment objective. The banks, as you know, will take deposits, they create loans. The insurance companies will invest in the market because they have insurance risk liabilities. The pension funds will invest in the market because for pensions, our pensions are monthly contributions which will be invested by a pension fund company so that we have wealth at the end of our retirement, working life. Investment companies will invest through mutual funds or will invest directly for its customers, depending on the individual customers that we have. The capital market ecosystem and framework have different participants. We have the issuing house, who are responsible for helping companies raise finance. The asset managers, who are the fund managers who help investors like you and me to invest our money. The custodians, trustees, and registrar underwriters are all supporting capital market operators who will help keep the investor cash in the benefit of the investors. We have the stockbrokers and the rating agencies. The rating agencies are very crucial. They will create the risk assessments for the companies and the governments in question, and the receiving banks. This framework is designed and highly regulated by the Securities Exchange Commission for the capital market, the CBN in some cases for the banks, and this will help create investor confidence that there is a regulator who is actually monitoring the activities of capital market operators to give investors comfort that whatever investments they have, there's a framework and a process when we take money from clients and we invest for them and we present reports to them as well. So why do we invest? What is our investment objectives? Investment is long-term. Investment is about creating wealth in the long term. It's not about investing for 6 months or 1 year. It's about looking at the long time horizon to create wealth. You know, because wealth and cash is eroded by inflation. Inflation is about increase in prices. When you invest, you receive a return and interest, which in some cases exceeds the inflation rate in the economy. We're looking for financial security in the long term. You know, today we have to take responsibility for our finances and for our wealth creation in the long term. Gone are the days that we invest and keep money in the bank. And there's this big myth about investments. You know, you must be very good with the stock market. You know, you have to be very good in maths. You have to be rich. These are all myths. It's all about your tenacity, your interest, and you taking responsibility, you know, for your wealth and cash in the long term. When we look at investments, we're looking at 3 key things. There are 3 requirements. What is our time horizon? How long are we investing for? Is it for the short term or is it for the long term? What are the key things we're looking for? We're taking a risk. There's risk in investment, but there's a return to compensate for that risk. Some risks are small, some risks are big. And another key point is liquidity. You know, when we invest for the long term, we need to think about liquidity. When we invest in marketable securities like the federal government bond, which is highly actively traded. You know, so what is a return? A return is an increase in the cash that we have deployed or put to work in a specific investment. Here today, we are setting out the type of investments you could have. You could have cash in the bank. You could have an equity investment. You could have fixed income investments. You could have real estate. You could have commodities. We'll talk about these individual investments in subsequent slides to give you a flavor about, you know, what they are and what their futures are. Equity securities and cash management. So as I said earlier, equity investment is all about investing in a company. We are all shareholders of this company. We will earn a dividend. But what is critical? There is risk. The risk is very high in equity investments. You can look at companies like Coca-Cola, Nike, Apple. These are all listed companies in the US stock exchange, one of the most active traded stock exchange in the world. Anyone who invests in these companies is a shareholder. You know, when we think about cash, so there's also always this thing. Do I keep the cash in the bank or should I invest in equities? You know, cash in the bank gives you 0 return. Because when you leave the cash in the bank is actually doing the investments on behalf of the bank and giving you 0 or no return. Wealth creation is about deploying that cash, not leaving cash in the bank. One thing we must always be conversant with is the equity market is very volatile. There is a history in the equity market that over a longer time horizon, equity market will always outperform the fixed income market, the currency market, and the commodity market. And why is this? Equity market is volatile. It's about investing in companies. Companies will grow. You know, companies will grow when they from one year to the other, and there will be growth in dividends. There will be growth in the share price. But again, if there's an investment life cycle, there's always a life cycle of expansion, there's a boom, a recession, and a depression. We've seen this in Nigeria. We remember in the days of the Obasanjo administration where there was a big boom. We're seeing in the Buhari administration that there was a recession. And the impact of COVID is very significant. to the stock market. It's something investors need to be aware of, that markets are volatile, but in the long term, we will see the results. Every capital market, equity market will always crash. At the chart at the right is the S&P 500 index. It doesn't go in a straight line. There is huge volatility. As we can see there, we can see the pace of growth on the left-hand side. You know, in 2020, we saw a huge decrease in the share price in the US stock exchange. So fixed income instruments. What is a bond? You know, a fixed income instrument is one of the low risk investments. The most you can lose is the principal at the point of maturity if the company does default. The fixed income instrument is a contract between the issuer could be a company or it could be a government. The issuer, you know, there's a rating agency that will look at the performance of the issuer to help you understand the risk in investing in fixed income instrument. It's a very good hedge. When the market is very volatile, investors always move to fixed income as a hedge against equity volatility. So we have different types of fixed income instruments. We have the money market instruments, which is short term. We have the bonds, which is medium to long term. We have the medium term notes, which is another form of bonds, 1 to 10 years. The Euro bond is just a bond in dollars, issued in dollars by a country, which is not a US country. Municipals are local government bonds, and we can see the difference is just about the time horizon. Money market is dated, maturity less than 1 year. Usually a bond is very long dated. We can see a table here that sets out, you know, the time horizon of our bond. 1 year, 10 year, and over 30 years. This is a general theme for bond instruments. And we have floating rate bonds. So these are bonds that the interest rate will change based on the change in an index, like the LIBOR rates, NIBOR, Treasury bill rates, and the interest is paid semi-annually. We have 3 types of bond coupons. Coupons are interest payments by the issuer. We have a zero coupon bond, a fixed rate bond, and a floating rate bond. A fixed rate bond pays a fixed interest throughout the term of the bond. A floating rate bond will pay coupon that changes every quarter based on the change on the underlying index. A zero coupon bond has a fixed interest rate over its tenure. So our Treasury bills in Nigeria is a zero coupon bond, but short dated over 1 year. So in this table here, I'm just setting out the different type of money market instruments, Treasury bills, commercial paper, and certificate of deposit. Treasury bills are zero coupon bonds usually issued by a federal government. We know about the Treasury bills in Nigeria. They were one of the highest paying instruments in the last 2-3 years, but we've seen how that market has actually reduced in value. Commercial paper is a short-term debt issued by companies and banks. It's similar to the Treasury bills, but the interest rate is slightly higher because they're considered to be high risk compared to the Treasury bills. We have real estate investments. You know, other investors would think about investing in something that they can see, like a building. It could be a house, and real estate investments is all about location. Real estate is a hedge against inflation, and it also goes with the economy. In a strong economy, we have a strong real estate market. In a weak economy, we have a weak real estate market. Real estate could be for development, where you develop a real estate and you sell it, or it could be an investment where you buy a commercial real estate building and you actually charge interest through a lease term to the clients. Commodities is another good investment. Commodities is very big in international market, trading in gold. Gold is a very good hedge when the economy is very weak. Investors tend to sell equities and move into gold. Silver, oil, agriculture, and mining. You know, commodity trading is very big in international market, and we have this already kicking off in the Nigerian market as well. It's an alternative asset. Other type of assets, again, is investing in luxury goods. Some people like sports cars, in wine, in paintings, and in other assets. So these are alternative assets, usually for high net worth individuals. And also, as you know, cryptocurrency, digital currency, it's a new kind of disruptive asset class, as we can see. It's a hype, basically where investors come in to invest in crypto, and we've seen the tremendous increase in price in crypto, even though there's been a quite shaking in the system where the central banks are also looking at digital currencies today, because they don't know if crypto sometime will come in to displace the existing assets. But again, for every asset, there has to be fundamentals, valuation around that. We talked about equities, growth in a company. We talked about a government looking to, fund its budgets. There are usually fundamentals that drives an asset class. At the moment, crypto is all about the futuristic value of what crypto is going to do. We know Facebook is looking at cryptocurrency. We also know about the electric cars, trying to look at crypto, as a medium of exchange in the future. So we have to watch the space for cryptocurrency. So investment is all about risk. When you take money out from the bank to invest in any asset class, it's all about risk. But for every investor, what's your risk tolerance? What's your risk appetite? That's the starting point. Am I low risk, medium risk, or high risk, or moderate risk? Every asset class will talk to this. What is your emotions about risk? People who are high risk love to drive fast sport cars. They become skip divers. They love to invest in equities. The higher the risk, the higher the return in the capital market. But sometimes we have a circumstance in Nigeria where our Treasury bills in the past gave us a lot of return. We're doing about 15 to 16, 18% 2-3 years ago. The return was high, but the risk was low because the government will not default. But we're seeing a correction in this today. And so investors need to always think about risk. The higher the risk, the higher the return. But again, what's important is what's your risk appetite? How much risk can I take? And here we're setting out the different type of risk: interest rate risk, credit risk, inflation risk, liquidity risk. All this risk affects the value of our investments. Investors need to be aware that for every investment, there is risk. There is market risk, there's political risk. For example, if you invest in a Nigerian government bond, an investor will be concerned about political risk. Is there going to be chaos? Is there going to be risk of control of currencies, instability in the government, change in government policies? So these are things that keep investors awake. Liquidity risk: if I want to sell the asset, can I sell it in the market? Currency risk: there's a huge risk, the Naira and the dollar. The Naira has been devalued over the last 2, 3, 4, 5 years, and it hurts investors. But again, there are different investments that will hedge against investments in currency like Naira. So you can look at the dollar investment. Market risk and interest rates are linked together. Change in price. The price that you put in will always change. So when you think about market risk for fixed income instrument, one thing you must be aware of that there is an inverse relationship between the bond price and interest rates, the yield of the bond. When the price goes up, the yield will go down, and vice versa. When the yield goes up, the price will come down. The yield is the rate of return on your investment in a bond. And here, this table just shows you an example of a bond that was priced at 91, yielding 9%. And when the yield goes down to 70%, the price jumps up. Credit risk in fixed income instrument is very crucial. The credit rating agency is responsible for rating every issuer. And investment grade bonds are usually bonds rated BBB and above. As you can see in the slide below, there is a breakdown of all the key rating agencies: Moody's, S&P, Fitch. When you're rated AAA, these are like the US government, UK government. Big oil companies like ExxonMobil are highly rated organizations. When we look at here, this is a non-investment grade. This is where you find most Nigerian companies. The Nigerian government is rated B. These are non-investment grade. And here we're looking at junk bond, junk issuers rated very low. But again, credit risk, market risk is all about risk and return. When you look at this pyramid here, is to set out risk and return. Low risk for cash instruments when you keep money in the bank. There's literally no risk because in some cases you have the cash in the bank being insured by the government. You know, low risk investments are investing in mutual funds, in bonds. When you start looking at high risk, you're talking about equity investments, hedge funds, aggressive strategies. So when an investor will think about portfolios, you know, portfolio theory and risk just talks about how do we allocate our investments to create a portfolio that will hedge or manage our risk exposure, where in a basket of securities, we have a combination of equities, fixed income, and cash. You know, to our left-hand side is a conservative portfolio, which is managed by an asset manager that will put more money in fixed income instruments and very little money in cash or money market for liquidity, a little in equities, you know, and we look to your right, a moderate and more aggressive portfolio will have more in equities. You know, this portfolio theory and risk profiling is very important for investors to understand. And it's only an asset manager that is in a very good position to help you monitor these portfolios or create these portfolios for you, advise you on how the portfolio is performing and readjust the portfolio, sell high risk assets and buy less risk assets to tilt the portfolio in your interest. So for decision making, so this is the asset allocation, you know, which we're just talking about, just broken out in different dimensions here, where you're looking at how you hedge, how do you diversify your portfolio. Diversification means we don't want to put everything in one basket. We don't want to invest everything in equities. We want to mix and match because each asset class has a different risk and return appetite. Each asset class has different change in prices. Some assets will increase more, some will increase less. If you lose in one asset, you will hedge in another asset. And this is why you have to diversify your portfolio to reduce the risk. You know, an asset manager will advise you as well on what are the best investment strategies for you for decision making. Market timing, when is the best time to buy? What does the research tell us about these companies? When is the best time to sell? Do we hold value stocks? We look at stocks that we think are undervalued in the equity market, or stocks that pay regular dividends, or growth stocks. You know, an asset manager will help every investor understand these different strategies. What is your risk tolerance? What's your financial goal? What's the investment horizon? Am I investing to buy a house? Am I investing to pay a medical bill? Am I investing to build a plant? You know, and so that's the horizon. The investment horizon is a timeline of your investment. So investing is very difficult, you know, thing, very technical. What do in the current recession, people are skeptical about investments. They want to just put the money under their mattress, but I'm saying you have to invest. We have to invest for the future. What is the theme in investment today? What is the change in the way we live today? We've seen companies like Zoom listed in less than half a year, and the share price is like gone so wide. So fintech, these are the disruptive industries, healthcare, you know, technology, climate change. These are the new digitalization. We're investing in the future. In a recession, you know, what are we looking at? What are, you know, in the lockdown, what industry was moving? Healthcare, consumer goods, utilities. So an investment manager will help every investor make very good investment decisions. So, when you look back at investments, it's highly technical. Monitoring this is a big deal. You need an asset manager to guide you through the investment life cycle and investment process. Capital Field Asset Manager is well positioned because the company is a company that has a culture of excellence. We're deep in technology. We are robust in our investment process, and we have seasoned professionals. Our investment process is deep. We have a big research team. We look at portfolio construction. Risk management is very key to us. So this sets out our investment process. This is how we are structured. It's about research. What companies are we investing in equities? What names in fixed income? Is it corporate bond? Is it Euro bonds? A bond issued in dollars? How do we evaluate a company? How do we evaluate an issuer? How do we track their financial performance? When we're creating a portfolio framework, how do we determine what investments to do? What analysis are we doing? How do we allocate the investments? How do we look at our risk? Because it's all about minimizing risk to get the best return for investors. Our key products that we have today, we have a fixed income fund, Camco fixed income fund, that has highly rated in fixed income instruments. These are mainly Nigerian government bonds. We also have the equity growth fund that will look at investing in equities, and the dollar fund. The dollar fund is actually investing in dollars issued by the Nigerian government. They are called Euro bonds, and by companies as well. So this is a list of our products, which I just set out earlier today, which investors, the fixed income fund, the equity growth fund, the fixed income dollar fund, and the money market fund. So to contact us, these are the processes, client engagements. We will monitor and register onboard you and complete all the required forms for this. Thank you.
All right, thank you very much, Mr. Mark Opo, MD, Capital Field Asset Management Company Limited. Thank you very much. A quick takeaway from what he has said this morning.
Hello, everyone. Good morning. My name is Afoke Richmond, the head Head of Corporate Communications, Capitol Field. Our moderator is having a bit of a technical hitch. However, our next speaker, who is going to speak very briefly, is coming on board, and that's the person of Mr. Oye, the MD of Allocation Consulting Limited. Over to you, sir.
Hello. Hello, good afternoon. Good morning. Still morning.
Yes, good morning, ma.
Okay, my name is Titi Adeni. Sorry, we're not able to see Mr. Echo, so I will just quickly come in. And thanks, Mark, for the beautiful presentation. I'm sure we've all learned and seen various asset classes and various risk, various appetite for an investor and where you can invest your money. And I'm going to just briefly talk about Capital Field Investment Group, who is the anchor of this presentation. In Capital Field is a group of companies, and we have various financial institutions embedded in the group. And that is why we can adequately play in all those sectors as highlighted by Mark. For example, we have the asset management, which you saw the MD with Mr. Mark Okor. And then we have a capital field financial management that takes care of and is licensed by central bank. When you want to create your assets, you have assets you want to turn into cash. Maybe you have a transaction you need to fund. We can fund in asset funding gap for you. We have various products that can come and tie to meet your various needs, both at the large volume and at the retail level. And when it comes even to the investment, our investment module are in the money markets, which are the ones with the low risk, even though we have heard about the ones with a high risk. We play vertically in money markets. That's for the financial management. That's the one the finance house that I mentioned is within the group. We have created notes which you can invest for short to medium term. I'm sure you remember the first speaker mentioning that you can only invest 1 year is the maximum for money market. So in the financial management, it's called capital field financial management. You can play in the short term form of investment. That is, if you are not comfortable playing in the long end, in the equities and in the bonds that are long tenured or medium tenured investments, you can play in these sectors where within the group as well. So, and also, this also depends on your appetite, the risk appetite of the investor at every point of time. When you always consider them, and then we are also quick to meet you at your point of need, and then we promise you we'll surpass your expectation. Thank you.
Thank you very much, Mrs. Titi Adeni, Sector Head, Capital Field Investment Group Limited. So please, we want to, if you have questions, please, you put them in the question and answer chat box, or you indicate by a raise of hand. Use the raise hand icon if you have any questions. Or you type it in the Q&A chat box. Thank you very much. Also want to say that if you are interested in the slides, please, under the comment section or the chat section, please indicate your email addresses. Indicate your email addresses so that the slides can be sent to you via your email. Also, if you want to contact us, if you want to, you can send an email to customerservice@capitalfield.com. customerservice@capitalfield.com, or you can reach us on this line 0145474432. I'll take that again, 0145474432. Okay, so we'll go straight to the question and answer session. Please, if you have any question, you can indicate by a raise of hand using the raise hand icon, or like was said, you should indicate in the Q&A chat box. Thank you very much.
I'm sure there must be questions.
Yeah, so Mr. Mark, I have a question. I would want to find out, if you don't have enough funds to invest and you really want to invest, what are your options?
Well, if you don't have enough funds to invest and you want to invest, what are the options? I think the best way to invest is through a mutual fund. So a mutual fund is a fund that is set up with a list of collective investors. For example, the money market fund. So an asset manager will create a fund, will collect a very minimum amount of money from investors, hold the money together, and invest in different money market instruments. So this gives each individual investor an exposure to a large array of investment assets. So for example, if they only had, say, maybe 5 million Naira, they're limited to investing for 5 million Naira, which can only buy a minimum of a set number of assets for 5 million. But if we took 5 million from 100 investors, we have a large sum to buy different asset class to give all the investors within that fund an exposure to different instruments. And that is the best way to invest without sufficient fund. And that's the benefit of a mutual fund. A mutual fund is a fund which is highly regulated by the Securities Exchange Commission. You have to have approval for that by SEC in Nigeria. And there are so many mutual funds in Nigeria at the moment. Capital Field Asset Management at the moment don't have a mutual fund, but we are working to actually create that within the next 6 months.
All right, thank you very much, Mr. Mark. We have a question for you. Our second question says, sir, what is personal projection on the future of cryptocurrency?
Well, I don't have a crystal ball, and I think cryptocurrency has created a lot of debates. You know, there's some asset managers and investors and banks globally who actually don't believe in crypto. They just sit on the sidelines to facilitate the matching of different investors who are active in crypto. So it's very difficult to predict. You know, we can see the prices of crypto going to very high volume most recently and going down. When Chrysler said they will accept crypto, we saw a big shift in the price. So it all depends on how readily acceptable this currency will be in the investment community and the economy as a whole globally. So it's very difficult to actually set a price at crypto. We currently are not managing crypto, but we are closely watching it as well within the Capital Field Investment Group.
Thank you very much, Mr. Mark. Okay, there's another question. Do you help investors in alternatives, that is, wines, paintings, etc.?
Yes, I think we currently are not active in alternative asset class, but we will partner with other big asset managers in alternative assets, wine and paintings. Yes, we could do that for them.
Another question. You said mutual markets or mutual money market has 1 year tenure to ROI, or to get your entire money back. Is this true?
Money market instruments have a 1 year tenure. So what does that mean? It means that the issuer is issuing that money market instruments. Treasury bills, for example, the Nigerian government will issue treasury bills. The tenure it actually starts from as little as 30 days to 1 year. And after 1 year, the Nigerian government could either repay you that money or roll it over. Rollover means they will not repay you the money, they will actually continue to give you a new rate based on the market at that point in time.
Mr. Mark.
Yes.
Mr. Mark.
Yes, please. There's so many questions.
Okay, yes. Did you get the last question? Is it better to invest in dollar funds than in Naira fund?
I think we are beginning to see in the last 2 years, actually the last 1.5 years, a huge interest in the dollar fund. And why is this the case? This is because the Nigerian Naira has been held in terms of the valuation of Nigerian Naira. The rate, because currency, the actual exchange rate between the Naira and the dollar should normally be driven by the interest rates in Nigeria and in the US. But the central bank, through its policies, has managed to hold down the exchange rates. It's not the true value. So, and they've supported this by policies, by actually pumping in dollars in the market to maintain that rate. So there's a devaluation going to happen subsequently in the Naira, which is driving that huge interest in dollar investment. So we're beginning to see a huge switch from Naira to dollar investments. The only issue we have in the market is we don't have so many new issuance in the market because the Nigerian government has not actually raised new dollar funds. So, and that will continue to shift the return on dollar investment. So this is a good time to invest in dollars.
All right, thank you very much. Another question, what is your view on the Naira exchange rate and the interest rate yield curve this year?
So my view on so this is also back to the dollar we're talking about. So the exchange rates between the Naira and the dollar, currently we're seeing it's moving between 450, 480, projected to be about 500. I think there's that psychological barrier that the central bank and the government, through its policies, do not want to see us go above 500. But I think with COVID, with the weak economy, there's a big debate that we should see a further devaluation in the Naira. But recently, we're beginning to see an improvement in oil price, oil production in the international market. So it's very debatable, but I think we will probably see a further maybe 5 to 10% devaluation in the Naira against the dollar.
Okay, Mr. Mark, I think this will be our last question. What is the average ROI per annum?
What is the average return on investment per annum?
Investment per annum, yeah.
Can you hear me?
We can hear you now. We lost you for a second or two.
Can you hear me now, Mona?
Yes, now we can hear you, sir.
So, okay, sure. So what is the average ROI? ROI is return on investment per annum, but again, ROI depends on the specific investments. Money markets, we're looking at money markets currently, the 1 year Treasury bill is doing an average of 4%. It was initially 1%, but it's gradually been increasing. Commercial paper, which is issuance by companies, and banks, we're beginning to see an increase of about 5 to 6% currently. The return on investments for when we start looking at bonds, we're seeing the average yield of bonds about roughly 6-7%, even though we have a huge coupon right now because most bonds are trading at a premium price. Equities, I think equity is very debatable. We could be seeing about 5 to 10% in equities at the end of 1 year. There's been a huge correction in equities from the boom we had in 2020.
Okay, thank you very much. Please, we want our participants to please be rest assured we're going to respond to all your questions and send to your email. So please, if you have not dropped your email, please kindly drop your email so that we can reach you with the responses to all the questions that we're not able to answer. We actually wanted this webinar to last for 1 hour. We've already exceeded our time limit. We want to thank each and every one of us. We want to thank Mr. Mark for his great presentation. I want to thank Mrs. Titi Adeni too. I want to also thank Mr. Oye, who eventually could not show up as planned. I want to thank all our participants. Thank you. If you were not here, this webinar wouldn't have held. Thank you very much. Again, please, if you haven't put in your email addresses, kindly put in your email addresses. You can reach us on customerservice@capitalfield.com, or you put a call through This line 01-4547-432. Thank you very much. My name is Mana Kawan, Group Head, Internal Audits, Capital Field Investment Group. Thank you very much for participating. Thank you for all our speakers. Thank you very much. Have a beautiful afternoon. Bye.
Thank you. Yeah.
It's on your last page.